the really cool things about being a financial advisor, maybe this is just the nosy busybody in me, but I get to look under the hood at how people are invested. One of the very first things I do with someone, even before they become a client, is I want to see how they're invested. What account types do they have? What investments do they own? A lot of times it's, plain vanilla stocks, bonds, CDs, mutual funds, index funds, etc. But sometimes I see some investments where I'm like, ooh, this is going to be an awkward conversation because this is a really bad investment. And knowing what I know about this person already, it's not a good fit for them. Now, most often, these investments are recommended by salespeople who are getting paid a big fat commission. And that's usually the answer as to why somebody owns a investment that they shouldn't own or is not an appropriate fit for them. So I want to talk about three criteria that every investor should use to evaluate an investment. And if it checks generally one of these three boxes, but a lot of bad investments will check all three. But if it just checks one of these boxes, probably should stay away. This is a principle that I've used for the last 18 years. It's something that you can implement whenever you're evaluating any type of investment, especially one that's being recommended to you by a financial advisor, insurance salesperson, whatever it may be. Criteria number one is it's expensive, high fees. The fees of whatever you're investing in should be able to be explained and understood in plain English. If you're not exactly sure of what the fees are, or you feel like you're unclear about what those fees are, or someone is telling you it's free, there's no free lunch when it comes to investment products. There's just not. Let me give you some criteria to see if it's expensive. Anything above 1% per year based on the assets invested. So if you're putting $100,000 into a particular investment and the fees are 1%, either like upfront commission or annually, if the fees are 1% or less, so it's going to cost you $1,000 either one time or are ongoing every year, that I would say is fair and reasonable. Can you invest for much less? Absolutely. But where it starts to get expensive, where these fees are now eating into your returns, because that's effectively what happens. Most of the time, when you buy an investment, you're not writing a check for it, you're not paying out of pocket. That fee is deducted from your investment, from your returns. So, where we start to get a little bit squirrely is on anything higher than that. So, if the all in costs are, 1.5, 2, 3%. I've seen this. That's ridiculous. And you should not be paying fees for that. It is much better and much easier nowadays to construct a low-cost investment portfolio where all in, even when you include working with a financial advisor, it's not hard to construct a portfolio where it includes paying me as your advisor, whoever else you're hiring, plus the underlying investment fees. Not hard to do it for at or under 1%. Okay, the second criteria that makes a bad investment, particularly for retirees, is it's risky. But very importantly, it's wrapped in a veil, a beautiful veil of safety. If it walks like a duck, acts like a duck, talks like a duck, it's a duck. Be very, very careful because there are a lot of investments out there that appear to be low risk, but you have to ask and you have to do your due diligence and find out how did this investment perform in recessions, down markets? How did it behave in inflationary cycles, different interest rate cycles? So, first of all, the investment needs to have a track record because if you can't look back and figure out how a particular investment performed in good times as well as bad times, you don't want to find that out the hard way. A perfect example of this, especially one that really swindles a lot of retirees, are anything with a really high income. And all you need to do to figure out if something is suspect is look at what is the current interest rate environment. What's the rate I can get on a lower risk investment like a CD or a treasury bond? Right now, in the fall of 2025, when I'm recording this video, it's about 4%, give or take. So something as low as, 3.5%, depending on the length of maturity, all the way up to 5% would be a reasonable interest rate that you could achieve in this current environment. But people will be seduced by like a 8 or a 9% yield on their investment. High yield generally equals higher risk. But it'll be sold with this package of like, "Oh, this is a high yielding, low risk investment." If it's so great, then why isn't everybody investing in this? Like it wouldn't even be available and it wouldn't last for very long, and the demand for it would push the yield down because they wouldn't need to offer such a high income or a high yield on this particular investment if everybody was clamoring for it. That's just not how basic supply and demand works. So, if something is noticeably higher than the prevailing interest rate, it just means that it has to be high yield for a reason. And usually the reason is that there's an additional risk well above and beyond that of a comparable treasury or a corporate bond or a CD. The trade off for that additional yield is high risk. And for most retirees, if you're giving up your hard earned money, you don't want the interest payments to stop coming. So if it's paying you 9%, great. But what happens when that stops in a year? Now your investment is completely worthless because it's paying no income and you've stopped getting paid. I've seen this time and time again. It's devastating, and that's why you want to be very careful of anything that is really high yield, well above market interest rates for normal, plain vanilla investments. The third criteria, don't touch this with a 10-foot pole, is anything illiquid. Every single holding in your investment portfolio should be easily sold. There's a market for it. You can easily call up your advisor, log into your brokerage account, and hit sell. If you cannot do that, that's a problem. Private investments like, hedge funds, venture capital, private equity, historically very illiquid, which is why they're only allowed to be purchased by people who can afford to have the illiquidity, people with a really high net worth, a really high income, lots of other assets. Whereas if this illiquid investment dried up and they couldn't access it for 5, 10, 15 years, which is very common, are they going to be okay or do they need that money? Well, most retirees, you need access to that money and you can't afford to be investing in anything that is illiquid. By the way, real estate falls into this category. Now, I know there are people out there who absolutely love real estate, but most of the retirees that I deal with, it is a thorn in their side. Real estate is illiquid. It's problematic when you need to sell it. A lot of times the fees and the net return on most real estate, which most retirees are going to have like a rental property or a vacation home, Airbnb, it's just a pain. They don't want to deal with it anymore. And you can't easily sell it. And if you do, if you sell it at the wrong time, like right now, the real estate market's absolute garbage. They're forced to either hang on to it and the cash flow is horrendous, or they could sell it and take a big haircut on it because it's illiquid and the timing just didn't work out. What I find for most of my clients, if they go into real estate, they amass different rental properties, and then they get to their 70s and into their 80s, and they're like, I don't want to deal with this anymore. I'm done. I want to sell it. And then you're dealing with the capital gains in a lot of cases. It's just a huge headache. I know I'm biased, but I'm biased partly because I see my clients who go down this path and then they regret it much later on. And the promise of real estate and the sexiness of real estate, it sounds great, but like in reality, it's just for most people, the cash flow and the income that you get, it doesn't justify the headaches. If you're new here, my name's Ashley Mitchell. I'm a financial advisor. And for the last 18 years, I've been helping my clients retire with confidence. And my goal on this channel is to simplify all the complex questions about planning your retirement so you can focus on what really matters, which is enjoying your retirement, living your retirement, not worrying so much about money. That's my job here to help you not outlive your savings that you've worked so hard for, to help you live a more financially secure retirement. Thanks so much for watching. See you next time.